Welcome to the Solution Nation podcast. My name is Sean Snowday, and I'm the president of Solution Nation. Solution Nation is dedicated to providing a platform for investors to learn about Israel's most dynamic public and private companies. We interview lead venture capitalists, Wall Street analysts, investment bankers, and managers of incubators and accelerators. Today's topic is unicorn accounting with Professor Damodaran, a true luminary in the valuation world. He provides his insights into the proliferation of unicorns. Should unicorns captivate the public's attention? Why does it matter how private companies are priced? What, if any, risks do unicorns present to the broader economy if they implode? Learn that and more in today's podcast. Please remember that all content provided on the Solution Nation podcast and website is for educational purposes only. Nothing shall be construed as investment advice. Investment decisions shall not be made based on information, written, verbal, or otherwise, posted or spoken on Solution Nation. Conduct your own research or consult with your own investment advisors before making investment decisions. So here's my good friend, the host of the show, and the CEO of Solution Nation, David Wanatik.
Welcome, everyone, to Solution Nation. I'm David Wanatik. Today, we're going to talk about unicorn accounting. Speaking with us today, very pleased to introduce Professor Aswath Damodaran. Professor Damodaran holds the Kerschner Family Chair in Finance Education and is a professor of finance at New York University's Stern School of Business. Before coming to Stern, Professor Damodaran lectured in finance at the University of California in Berkeley. For those of you that are involved in finance and especially valuation, Professor Damodaran needs no introduction. He's probably the best known valuation expert in the world. He's written a number of books, and Professor Damodaran is not a superb professional as far as valuation, but he's very generous. His websites, he provides lots and lots of very helpful data, lots of great information about cost of capital, comparative profitability for companies in different industries, just a wealth of data that everybody should take a look at when they're approaching valuation exercises. So Professor Damodaran, thank you very much for joining us.
You're welcome.
So anyway, over the last decade or so, there's been a proliferation of unicorns. Unicorns are really not unique anymore in the world of private equity investing. Do you see that as solely a healthy thing, that more and more companies are richly valued? Is that only a good thing, or are there some concerns that one should have when we see so many newly minted unicorns?
Like everything else in business, there's a good side and a bad side. It's good to have young businesses have access to capital and be able to grow. And we live in an age of disruption, right? Every business is being disrupted. So from that aspect, I think it's good that there is a climate where young companies are able to access capital and get high valuations when they go public. The downside is when you have excess capital floating around and looking for opportunities, you're going to see some companies being valued at numbers you shouldn't be paying. But the question is, why should it matter to us? What difference? I mean, I find this whole fixation that people have with what other people are paying to be extraordinarily unhealthy and completely useless. What difference does it make to you and I that somebody pays a lot of money for a company that's not worth that much? They're not investing in banks, so they're going to bring the rest of us down. So in a sense, I think we need to stop worrying about what other people are paying and wringing our hands about them overpaying. As long as you and I are not overpaying, I don't think it's any of our business. So I think part of this is, I think, a change in economics where you're seeing more stable businesses being disrupted, a lot of startups going after these businesses, and some of them are deserving of the $1 billion value tag that we're attaching to unicorns. Incidentally, that $1 billion value tag is completely arbitrary, right? What's so special about $1 billion? Why not 800 million? And one thing to factor in is inflation alone can explain why $1 billion is becoming more common. 25 years ago, during the dot-com boom, I'll wager there were just as many unicorns. The only difference is a unicorn in the 1990s would have needed to reach only 400 million to arrive at the same $1 billion valuation. So some of this is artificial. And one final point, the way we conclude that a business is worth $1 billion is we look at what a venture capitalist invested, and then we extrapolate from there. In other words, a VC who gets 5% of a company for 50 million, we're saying that must mean the company is worth $1 billion. But that is not necessarily true, given the way venture capitalists get other things in addition to a share of ownership in the company.
Okay. So I suppose it would be more of a problem if many companies pursuing the same problem were receiving very, very high valuations. But
again, a problem to whom? I mean, I want to see who's facing the problem. It's a problem for the people investing in these companies. But as long as you and I are not there, why is it our problem?
It still has a spillover effect. If it's great when things are going up.
No, that's not true, though. Not in the tech business. The spillover effects in the tech business are really isolated to the people investing in the business. There are other businesses where you can argue about spillover effects. Obviously, financial service businesses, and maybe the portion of the tech business that's fintech, we need to worry about more. When you access capital to enter lending businesses, and Klarna, for instance, where you pay now, you buy now and you pay later, you can argue that segment of tech. The reason I want to take the word problem out is we know what we do with problems, right? We try to fix them. Mm-hmm. And the fix then is we need to protect investors from their own mistakes. So we shouldn't let these. I think that's absurd. The SEC has no business getting between a fool and his money. If you really want to invest in a company that you think is worth $1 billion, even if it's worth only $100 million, who am I to stop you from doing it? But if there is a portion of this of technology where there is a spillover effect, then maybe we need to isolate our attention to those businesses rather than worry about all unicorns and the damage that they might do to the rest of us.
Sure, I agree with you. I don't think the government, the SEC, should regulate this or get in between investors. But investors, I think, should be careful in managing their own money. Maybe you can talk a little bit about the economics of a fund, a venture capital fund funding a unicorn. So if you have somebody like Adam Newman from WeWork, now he has a new startup, he goes and seeks capital at a venture capital firm, let's say. He needs a lot of capital, hundreds of millions of dollars. It's easier, right, for a VC to invest hundreds of millions of dollars that has many billions of dollars under management. If they make the right bet on a very large investment, the return on their whole portfolio will be very good, but they might need 100 positive returns on $2 million bets to deliver a high return on their entire portfolio. Anything you'd like to say along those lines?
I mean, why is this unique to VCs? It's true for all of us, right? So it's the old argument about concentration versus diversification. If you can pick the biggest winners and put all your money in the single biggest winner, imagine putting all your money in Tesla 10 years ago. You'd obviously wipe out almost anybody who competes against you with any kind of diversified portfolio. But I think the question is, I mean, if you're a sensible VC, and the VCs who survived are sensible VCs, the VC business is a very high shakeout rate. They've learned through hard experience that concentration might bring a big upside, but it's also going to bring you down. I mean, we're seeing this. SoftBank, I think, entered the VC business in a very, 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 very un-VC-like way, which is they made big concentrated bets on companies that they thought would succeed, which I thought was a sign of hubris. I think Masa Son and the people who were closest to him, I think, were guilty of playing God. And guess what? They're mopping up the results of their mistakes as a consequence. Good venture capitalists have always recognized that young businesses are risky, that even if you feel secure about the future of a young business, there are too many things that can go wrong and that you should spread your bets. So much as you and I or anybody else wants to pick the biggest winners and put most of our money in it, that warning note should always be there saying, how do you know that this is the winner? In hindsight, we know what the winners are. But in 2011, were you that sure that Tesla was going to be the winner over the next decade? I wasn't. And very few people were. And the people who made the bet, I'm not sure how much of it was just luck rather than analysis leading them to that judgment. So venture capitalists have to make that trade-off. Do you want to go for the big bet where you take a big chunk of your investor money and put it on one company that you think is going to win? Or you're going to spread your bets? And if I'm putting my money in a VC fund, I'll take the latter over the former every single time.
Yeah, it is hard to manage 100 companies, or at least to supervise that, or to be on
But
the
you
boards of
don't,
100.
right? I mean, VCs, for the most part, are passive investors. They're investing in companies which are very young companies. I mean, they might, take a look in. And for the most part, the way to think about these, especially if you're looking at pre-revenue companies, you're investing in options, right? That's the way to think about it. And you're investing in options. And if you're investing in options and they're out of the money options, as many of these companies are, you know that 2/3 of young companies don't make it through year two. What you have to do is hope that the winners in your portfolio will end up paying for your losers.
Mhm.
That's always been the nature of VC investment. You invest in 100 companies, 85 of them don't win. If you're lucky, maybe 15 or 20 will win. But the big winners are winning big enough that they can cover the losers. It's a very different mindset. That's why an old-time value investor cannot be a VC investor, because as an old-time value investor, you're taught to be risk-averse, to minimize your losses, and try to win on most of the companies you invest in. That's not what a good VC thinks about when he or she looks at at his or her portfolio.
So if you have a company that's valued at $1 billion and you want to
Price.
apportion,
I'm sorry to interrupt. No, VCs price companies. They don't value them. So that's the first thing we need to be very clear about. VCs play the pricing game. In other words, they decide what to pay for a company the same way you and I decide how much to pay for a house. We look at other houses in the neighborhood, see what other people paid for them. VCs never value companies, they price them. They price them based on what other VCs are paying for similar companies. So if you're looking at a user-based company, you look at what people are paying per user at other companies, and you attach a pricing based on it. So the first thing to recognize is unicorns are being priced at $1 billion. They're not being valued at $1 billion. It's a very different game, because the way you win at the VC game is you buy at a low price, you sell at a high price. So you buy a company that's priced at $1 billion, you sell it when it's priced at $2.5 billion, you're a winner. The fact that the value of the company is 200 million is completely irrelevant in this stage of the process. Eventually, the truth will come out, but who knows when that'll be?
Right. So along the lines of pricing, there's, a skeptic could say, well, I'm looking at this unicorn, it's priced at $1 billion. That really doesn't reflect what a lot of investors think. Maybe this management team went to 20 very intelligent venture capitalists, and they all declined to invest in that company. And then they went to the 21st one that wasn't such a smart VC, and that's where the pricing came about.
I think you're making a good point about how we come up with the overall pricing of a company. We base it on a single VC investment. And as you pointed out, that single VC might be the stupidest person in the room. We're extrapolating from that to the entire pricing of the company. That's why not all pricing is created equal, right? So if you have 10 companies claiming to be unicorns, but one is priced by 3 venture capitalists at $1 billion, the other is priced based on 1 venture capitalist, I take the 3 over the 1. And if 2 companies are priced by 3 venture capitalists and one is priced by somebody like, a Kleiner Perkins, a VC of long standing, I'd probably put more credibility on it. Because remember, these pricings are not coming out of a traded market. We have hundreds of transactions. You have a single transaction. You're extrapolating from that transaction. You need to be cautious. But then the question is, again, why let it bother you, right? So in a sense, let's say you take a stupid VC, you extrapolate from that pricing, you come up with $1 billion pricing for a company. You count it as unicorn. You know who it helps? Journalists who want to write about how many unicorns there are. Again, if you're not the person investing based on the billion, it doesn't matter. It's like a wave in the ocean. It's going to come in, it's going to go out. So I think that, we've made this a big story by focusing on how many unicorns there are. And there's gaming now going on in the system. And I'll give you a very simple example where even a great VC can be induced to attach a pricing to a company, which is really not worth $1 billion, but to push it up to $1 billion. Let's say that my business is worth only $500 million, but I want to be counted as a unicorn. And let's say you're a very sensible venture capitalist, and I offer you 10% of my company. Now you're going to say, look, I'll supply you 50 million in capital. So you'd supply 50 million, I'd give you 10%. But then I say, you know what, I'll sweeten the offer for you. If you give me 50 million, I will give you the right to adjust your valuation, your pricing to whatever the next round is. If the next round is at 2 billion or 3 billion, I'll let you take the percentage you get and double it. These are called ratchet clauses. Most VC pricings are not straightforward. This is in Shark Tank, where you give me 5%, I give you 50, you give me 50 million, I give you 5%. Here you give me 50 million, I give you 5% plus this, plus this, plus this. And these are all options that add to the value. And if we game the system enough, if I give you enough protections as a VC, you might take 5% instead of 10% for that 50 million because you're getting all these goodies on top. That's why without knowing the full terms of a VC pricing, even if the VC is credible, I can't extrapolate to the total pricing of the company. There's a lot of sloppiness in the stories that have come out about unicorns that I think we need to take into account. There aren't as many unicorns as journalists claim there are, partly because of the way the extrapolation is done. And some of them, the pricing is based on one pricing and 2% of the company. And you know what? I can do all kinds of things to get you to pay for that 2% to make it look like I'm $1 billion company. So by attaching this special respect and value to the billion, we're encouraging companies to play stupid games to get to that $1 billion pricing.
Back to that's a good point. So another maybe trick that one can deploy to receive a high price is to offer the last round of investors their money back, maybe a multiple of their money back, maybe 2 or 3 times their most recent investment when the company has an exit, an acquisition or IPO.
That's an option. I mean, that's what I meant by these goodies is they all take the forms of options. They're either call options that give you more upside if you do well, or put options that protect you on the downside. Each option has value. In fact, I wrote a post about how I can take a $500 million company, pay $50 million for the company, settle for 5%, but with enough options, still be okay as a VC in the company. So almost everything you see as an added clause in a venture capital contract is an option. Options for the upside, which would be call options, option to protect you on the downside, which would be put options, and each of those options has value.
Mm-hmm. Just companies that raise so much money, I think a lot of value can be apportioned to the cash. So look, you have a company and somebody puts a value on it. Maybe you don't want the VCs to, but a valuation firm might put a value on the company. Then you have to apportion. Usually you see a young company that doesn't really have anything going on other than some people and an idea and a business plan and maybe some patents. So, you allocate a huge amount of value to the people and to the patents. But I think the cash reserves the company has is also very important. When you have hundreds of millions of dollars, you can start to reshape industries. We've seen Airbnb, they've reshaped the hospitality industry. We've seen Uber and Lyft reshape the taxi industry. Right. So the money itself does deserve a lot of apportionment for value, I would think.
I'm not sure it does. I'm not sure any of the things you described create value. They create change. And we have, in fact, by giving so much capital to these disruptors, given them almost disproportionate power to change businesses. I mean, if you take Uber and Airbnb, and those are good examples, and you cut off the supply of capital. Remember, Uber, before it went public, had already burned through tens of billions of capital. That access to capital is what allowed them to get to 420 cities before they went public. That's the big change between what used to be true in the 1980s and what's true today. In the 1980s, VCs supplied tens of millions, perhaps hundreds of millions was a big investment. So you very quickly ran into a ceiling if you were a young growth company, where if you needed more capital, you had to go public. Take a look at the Apple and the Microsoft prospectuses from the 1980s. These are companies with immense growth potential, but they tapped out venture capitalists. Venture capitalists told them, look, you're too big now. We can't give you the amount of capital. You have to go to public markets. But then, especially in the last decade, we created a scenario where we created a gray market. These are companies that are not quite private businesses with access to venture capital. They're not quite public companies which are in markets. They're these companies that operate this middle space where they're privately owned, but they're still getting capital from public equity investors. Fidelity and T. Rowe Price invested in Uber before it went public. And what that's allowed these companies to do is have access to capital, so they're getting the good stuff, without any of the downsides of going public, not the monitoring, not the analyst following, not the disclosure requirements. And that is potentially dangerous for economies. I think that is something we need to think about, is businesses that are able to get as big as publicly traded companies without ever having the monitoring that comes with it, because there's so much capital flowing to them and with so few strings attached. They're able to do things with this capital that allow them to change entire businesses.
Right. And there's a lot of misuse of all of that cash. You're putting hundreds of millions of dollars cash into the hands of usually very young people without managerial experience. And in some economic cycles, the venture capitalists don't want to scrutinize their misuse of the cash too much, because the VCs are competing with each other to get into some of these hot deals.
In good times, that's always been the case. That'll never change. In good times, this is true for private and public markets. Guess what we all do? We get sloppy, we get lazy, we stop monitoring, because the reaction is, hey, no matter what they do, the price is going to go up. And for what? And you know what? For a decade, turned out to be a pretty good assumption. VCs could be casual and lazy, and then they flip the company over for 4 times what they paid for it. I think it's the only way people learn lessons is we can lecture people till we're blue in the face about how you need to monitor managers. But you know what finally brings the monitoring? Is a correction. In fact, a few months ago, I wrote a post on risk capital. And I talked about how risk capital has had a decade of absolute access, amazing amounts of risk capital flowing to companies, which is what you've described in the unicorns and the amount of capital that the Airbnbs and Ubers had. And I have a feeling that the spigots are going to get shut off, that risk capital has gone to the sidelines, not just for the next few months. It's not just waiting for the Fed. But we're going to go through this, because this has always been the case with risk capital. And by risk capital, I include VC money invested in the riskiest assets, the riskiest stocks. And I think that we're in for an adjustment where that risk capital is going to become scarcer. And when it becomes scarcer, you're going to see a lot more monitoring. You're already seeing a lot of down rounds at companies. And I think that's to be expected. But you're also going to see a lot more intrusive venture capital investing. Intrusive in what sense? They're going to be in the boardroom. They're going to be sitting in decisions. But the only way they do that is once they've learned their lesson, that if you don't do that, that bad things can happen to you as an investor. So in a sense, this is healthy. The shaking out of risk capital might be the way in which we all, and it's not just VCs, we've all become more sloppy as investors. And this might be a reminder to us that if you do that, you're risking a lot more than what you've invested in these companies. You're risking your entire portfolios.
Right. Maybe you can just say a few words about the consequences, the problems with down rounds. It's obviously demotivating to managers and employees that have stock options and so forth. What are some other problems associated with down rounds?
It could be fatal. It could put you into a spiral of what I call a debt spiral. Right, which is you have a down round, employees not just demoralized, they leave the company. right? New venture capital is not. So in a sense, down rounds create more down rounds. And the question is, where's the floor? And as we saw in 2001, if down rounds become vicious enough, a lot of companies cease to exist. So this is not just a bump in the road. This could be a wall you're hitting as a company. So when you see down rounds, you hold your breath saying, please, please don't let the floor be zero. Mm-hmm. And for many of these companies, that could very well be the floor.
So what happens when a large operating company acquires a unicorn for $1 billion and it's not really worth $1 billion, it's worth 400 million? Should investors of that public company expect there to be a lot of write-downs, and what are the accounting and economic consequences of the aftermath of an acquisition?
Do they know when they're acquiring the company they're overpaying, or is this something we know in hindsight? Because this, in any acquisition, if you overpay, we know what happens. Eventually, the market adjusts. Forget about accountants writing it off. By the time they get around to it, we all know it's happened. In fact, I think the impairment of goodwill is one of the biggest wastes of time in history, because by the time you impair goodwill and say, hey, we made a mistake, the market's reaction is, we know. It happened 2 years ago. So in the history of acquisitions, and I'm a cynic when it comes to acquisitions, is more value is destroyed through the acquisition process. It's not just unicorns, and it's mature companies. People tend to overpay on acquisitions of public companies. And when they do, the reckoning often comes from, first, on the day you do the acquisition, in 55% of acquisitions, the acquiring company's stock price goes down at the time of the acquisition, which is the acquiring company shareholder saying, I can hear all the glorious things you tell me will happen after the acquisition, but I just don't believe you. And if you track it through, acquisitions have a terrible track record in terms of creating value. So if you overpay for any company, unicorn or otherwise, then some of it will come out of your stock price right away if people recognize you're overpaying. But a lot of it will come when that realization comes that, hey, all this good stuff you told me would happen is not going to happen.
Mm-hmm. Okay, great. Are there any other words of wisdom you want to impart to us relative to unicorns and us not being infatuated with a notion of unicorns?
I think that don't make it a morality play, which is what I think one of my big concerns with the old time investors is they view this as a morality play, that it's shallow people who are, in a sense, it's almost heaven and hell. In their word, heaven is reserved for people who do their homework by nice, mature companies. And in their word, you should never buy a young company because there's too much uncertainty, too many things that are unknown. And for 20 years, value investors have been wandering in the wilderness precisely for that reason. Not only are they not investing in the unicorns, they're not investing in the Facebooks and the Googles and the Amazons and the Apples because they have this very, very rigid sense of what's good or bad. Don't make it a morality play. There are some unicorns that might be good investments, some unicorns that are bad investments. You have to decide whether you want to trade these companies or invest in them. By trading, I mean, you want to play the pricing game. It's all about mood and momentum. Get on that treadmill if you want and get off at the right time. And you might make a lot of money trading. But if you want to invest in these unicorns, well, guess what? You got to be willing to value them. And you can't use the excuse of, I don't know the future, there's too much uncertainty. You got to make your best estimates, value the unicorns, and invest in them if you feel they're being undervalued. One of the good sides of all of these down rounds and the cleaning up that's happening is some of the most undervalued companies in the market might end up being young tech companies, the Pelotons, the Zooms, after the correction happens. Because the nature of momentum, it cuts both ways. The same forces that push the pricing way above value will push the pricing below value. So don't be too quick to write these companies off, and never say never. Never say, I'll never invest in a money-losing growth company. At the right price, you should invest in these companies. At the wrong price, you should invest in any company, no matter how great you think it is. So I think if you keep that in mind, I think there is a place in every investor's portfolio for young companies, money-losing companies, or more generally, unicorn companies that are just making it up. But you got to make it a part of your portfolio. It can't be the center of your portfolio.
Right. Well, that's very good advice. You impart a lot of very interesting ideas, and we very much appreciate you sharing your time and your vast experience with us. So I think we can end the program at this point. Thank you again, Professor Damodaran.
Thank you. Appreciate it.